I mean, now you've had COVID, you've had rate hikes, you've had trade wars, you've had all this. Maybe we just need to adapt to the fact this isn't a phase. This is just the way markets work now in the digital age, in the fiat digital age. Maybe this is the way markets work.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I'm joined as always by the brain trust himself, Mr. Chase Taylor. Maybe it's a lack of sleep. I don't know. I haven't slept that good this week. Today's irritating. I don't know why.
Because the market was up 5% this week.
Yeah.
I think that's probably why.
Yeah. Well, we were up too. And it's completely pointless. So like a child, I'm just vocalizing my frustration, even though I'm completely aware of the fact that it will not do anything to help. I got to tell you, man, I am so exhausted at looking at a market that is just a joke. And to be fair, there, obviously we know there's stuff in it, that isn't. But yeah, I find it exhausting having to operate in a market and be benchmarked to a market that doesn't care about anything that is traditional investing and not anything. Obviously these things are kind of hyperbolic in nature. But I mean, when you're looking at things that on all, it usually, one of the things I've learned about myself is that usually if I'm disgusted by a stock or a market move in the past, it was usually in some way something I knew I should have done that I didn't do. You know what I mean?
Yeah.
What is frustrating to me about this environment is that you have so many securities out there that are priced at levels where that's not the case. You have so many things out there whose companies are doing very poorly, if not getting eviscerated, and the stock is going as violently to the upside. Is it just as a fundamental guy? The other thing I will say about the market that's a note, the other thing I feel now, not Xing out what I just said and not disregarding what I just said, because I find it to be, like I said, very intellectually insulting, frustrating, and ridiculous. Having said that, there is a feel that I have gotten back, especially in the last 2 or 3 days. The passive ratchet, man, it is back, right? And for now,
yeah,
right?
We talked about that a lot in the last few weeks. Like, hey,
yeah, the passive ratchet is back.
You're back to where systematics were empty and they were going to fill back up, and that creates a very steady buying. You would flip back into positive gamma, and that helps the whole thing push itself that much more. And we're there. And CTAs have bought a good bit, but like vol control is probably, 30-40% back.
Mm-hmm.
So they can keep buying plenty as long as vol stays relatively compressed. So you will have those mechanical buying there throughout. And to me, like, the less it makes sense, the more interesting it is, the more of a puzzle it is, the more reward there is for solving the way it works.
Usually I agree with you. But for a trader's mindset and a trader's mentality, that's fine.
Maybe that's the difference.
Yeah. Well, when you're managing other people's wealth and you're on the hook for it, and you're a fiduciary and you have to make sensible investment decisions, I don't have the ability to hop in to Palantir and Costco at 60 because the chart looks good. You know what I mean? Because and people are like, why not? And I go, well, let me explain to you. I know you know this, but I don't mean to you, but let me explain to you. Because if that news article or that headline comes overnight and that asset now all of a sudden is trading in intrinsic value, my clients are sitting on 60 to 90% losses, right? That's why, and that's what's so frustrating to me, is that so much of these stocks that that if I think the market's going up, these are probably the stocks that are going to benefit the most, but I can't touch them because they're ridiculous.
So just ignore them.
Oh, I know that's what I do. But you see the impact it's having, and we've talked about it a lot. Costco at 60 times. We talked about the way I got a really good laugh out of Alibaba's results the other day. Alibaba comes into the quarter trading at 18 times earnings. We're not long Alibaba, just in case anybody knows. But they come into it trading at 18 times earnings. They have a 34% revenue increase year over year, and the stock gets hit for 7%. Now, they did miss on earnings, but considering what was going on the macro level, that shouldn't surprise anybody. What I was laughing about is, had Apple trading at 33 times earnings posted that same quarter, the stock would have been up 20% in after hours, if not more, right? Like, if you think about where Apple's at, if Apple announced, 25, 30% top line revenue growth, the stock would have gone ballistic, and a company is a company is a company. Anyway, and the crazy thing to me, the thing that I'm bracing myself for is that if we keep running here, I have a feeling that a lot of the insanity we're looking at right now will seem sane. I think you could have a scenario where people are looking at you and going, well, man, this is your chance to buy Costco. It's down to 70 times earnings. Costco.
I mean, at the end of the day, if you just view it through the flow lens, going back to the deficits, like if the deficits don't go down, that flow thing will just mechanically keep working its way, and then the bathtub isn't big enough. So that's what you do get is, multiples just keep going up
until they don't.
Right, until the flow game changes, and then you have a violent unwind instead of a reasonable unwind.
Yeah,
or just a lost 20 years, whatever the case may be.
Yeah, I mean, I don't know.
We've talked about all those things.
Yeah,
many times.
Yeah, I just, and then you have to consider we've talked about this too, but you have to consider the other side. I mean, internet-based trading, phone-based trading, maybe this is normal. Maybe this is the new normal.
Yeah.
Like, if people knowingly want to go in there and bid up BS companies that they know are most likely frauds or not true, we've talked about that, but I just don't think you can look past that. Never before. Well, and it's hard because I think there are a lot of people who unwittingly get into these things too and don't know what they're doing. But yeah, I mean, it's not like all these retail participants believe that those stocks are worth that price.
I mean, they don't know that. That's not how the average retail investor even thinks about it.
No, I don't even think they know how to. I don't even think they can tell you whether the stock's expensive or cheap.
Right, story and narrative, and that's it.
So the question is, does this then end like it always ends? And I'm not convinced that it does. Meaning, what I have never seen is bubbles get popped, lose 85 to 90% of their value, and then reinflate at higher levels. And we've seen so many examples of that. So, which leads me to, that's a pretty rare thing, right? Especially when you're not talking about something that did it on a, like, for instance, when Carvana was down trading at like 50 cents and they had that debt run out and it went up to like $30. I don't consider that the same thing because, then you're on death's door. Now, all of a sudden you've got a lifeline that makes sense, right? I'm talking more about the run from or $50 to $200, $300, right? Like that just nonsensical where anybody could look at that and go, hey guys, so there isn't a car dealership on the face of the earth that's worth anywhere close to that. The economics don't support it. You know what I mean? Like you unequivocally, you could look at it and be like, yeah, that's not worth that. Right. So the question is, and we've talked about it before, and I don't think either of us have any answers, but at some point you've got to quit looking at this as now you've had COVID, you've had rate hikes, you've had trade wars, you've had all this. Maybe we just need to adapt to the fact this isn't a phase. This is just the way markets work now in the digital age, in the fiat digital age. Maybe this is the way markets work.
But throughout that, we've only had one fake recession. Like COVID went away. The trade war largely went away. So we keep as long as you have something removing the real roadblocks and you don't have significant, pressure on the economy, then because all those things you talking about had like an 80% decline. Most of them didn't have an earnings collapse, so they picked back up. You look at that. I can't think of the name of it. The like printed meat company,
Beyond Meat.
Beyond Meat. Like that's one. Like you look at the chart, that thing died and it did not come back to life.
Yeah.
So like if your business gets hit hard enough, like that was a dumb meme stock in 2020, I think it was, maybe 21. It got hit. It's not popular anymore. Its earnings got smashed and the stock's still dead. So, versus some of the other names where the stock got smashed 80, 90%, but then, they leaned out and they kind of fixed the operating side and earnings picked back up and yeah, the stock went nuts again. So, I think you still have all the possibilities of all those things. It's just if you're running a giant budget deficit, it papers over a lot of problems and
well, and this is my point. I think that I think that fundamentals and individual company results, do they matter? Of course they matter. So I don't want anybody reading, but I think as they relate to individual stock prices, I don't think they've ever mattered less. And I don't think that that's a sign that they're about to start. I'm not saying that, right? What I'm saying is, I think you've brought up so many different factors, right? Retail, mind frame, CTAs, all these different things. I think they have combined to make fundamentals and cash flows matter less than they have ever mattered on par.
I think they still matter plenty. I just think people are willing to dramatically overpay for perceived growth. Because, I mean, when was the last time you got sustained punishment for doing that?
You haven't,
right? It's been a long time.
I know, but then how do you explain? Like you wrap my head around, and granted it's one stock, but like watching that one. Again,
that's why I said perceived growth.
Yeah. And that's why I understood the Tesla mania when they're at 30 or 40%. It's ridiculous. It's laughable, right? The valuations were nuts. And, guys like me that were saying that their business will never grow into those valuations, we've been proven right.
But now they get flows they didn't used to get too.
Right.
So,
but yeah, and watching that stock rally 30% now off of those earnings results. That again, I put that in the stack of things that I didn't think you'd ever see, right? Like I didn't think markets had gotten to the point where a company at that valuation can announce those that can not growth collapsing, growth going backwards, right? Revenue shrinking and multiples expand. That to me is just, that's one of those moments where you got to step back and go, okay, I got to question everything I know. We were joking about it. That's when it's time for the meme tweet where you see the person, putting the intelligent investor book into the garbage can, because you're just like, okay. But it's fascinating. And it is funny the last couple of days, especially. I don't know why, maybe I'm just in tune to it, but it very much does feel like you're back on that just passive flow, 50 basis points every single day up and to the right.
Yeah. I mean, there's just no two ways about it. As soon as we flipped into positive gamma, I think it was like 2 weeks ago, and you knew,
they had to buy.
You knew like vol's going to keep coming down, and so many systematic buyers are just going to line up. You just picture like them all just lined up at the door to come in and buy.
So what I do think though, and I think that this is kind of the question I'm getting at. Now, granted, I mean, you can't have like an economic implosion, like an economy shutting down or a world war. I mean, obviously there are big enough events to adjust it. But on balance, are we to a point where the mechanistic aspects of the market have now become more influential than the original point of the market? And what I mean by that is, need I remind you guys, right? The point of a market, the efficacy of any market is price discovery. That's why it works, right? That's the value. I shouldn't say that's why it works. That's the value that it brings. But when you have enough of these mechanistic aspects into a market, right, they by definition are not a price discovery mechanism, right? ETFs are the opposite of a price discovery mechanism. They're purely a momentum play, right? So are you to a point now where the biggest driver in this market isn't the fundamental data; it's the mechanistic aspects of it.
Yeah, I think there's no question that, and it's it's multi-pronged. It's international flows, it's passive flows, it's the fact that the options market is bigger than the underlying. Like, so you have all these different, just massive drivers that have nothing to do with fundamentals or valuations or anything like that. Absolutely, it capital markets function so much more importantly for retirement accounts and things like that than they do for capital allocation.
Yeah.
So yeah, and then I mean,
And I'm not at all comparing the economic backdrops because there isn't any similarity. Okay, so I don't want to hear anybody reading into the exacts calling for an 85% market crash because I am not. And I will risk looking like a complete fool. I do not believe in the current setup that 85% market drops are even possible in the US. Not as things are today, right? Like I'm not saying it can't be in the future, but people are like, what do you mean it's impossible? Like, where have you been?
I mean, it would take a pretty wild exogenous shock.
Something insane,
Right.
right? And even then, I think you're more likely to get the market shut down for 2 weeks than you are to allow it to drop 85%. Just and I'm not saying that that's necessarily a bad thing. I mean,
no, that would be catastrophic for society.
Yeah. But anyway, my point is, when I think about the options trading, you brought that up. I haven't thought about that in a long time. But how the options market has just exploded, right? Like we've never seen anything like that. Isn't that fair to say?
Yeah,
like
I mean, it wasn't even a thing, 100 years ago, or like
it wasn't even really
75 years ago, or whatever. So
it wasn't even really a thing 6 years ago. Not
in
the same level.
Not in the same level and impact.
Yeah. And then you think about crypto, how big crypto markets have gotten. The parallels that I'm starting to see with this market to like the 20s, the excessive valuations, the big speculation, all of those things that people have known. But also one of the things that, if you go study the beginning of the Great Depression, one of the things that really aided and really hastened the market drop and really hastened the economic damage of that market drop were bucket shops, right?
Yeah.
Where people literally went in and were betting on stocks, not actually investing in them, making bets on them, right? And I was looking around and looking at so many of the stocks out there today, looking at the options market exploding. And the reason I think that this is important, guys, and I know you'll agree with this, and you could probably expound on this much further than I could, but so many different aspects change. Human behavior doesn't, right? Like it's the same. I mean, maybe over long enough periods of time,
Right.
but not over 100 years of market activity. Human behavior doesn't change.
It's the edge that will never leave us.
That's right. Negative edge.
pushing against. Well, that should be a positive edge.
Yeah. Well, yeah, but you know what I mean? Because we're all subject to it to some degree.
That's for sure.
Yeah. And the parallels, when I look at, like I said, the options market, when I look at so many of these meme stocks, when I look at crypto, I just see a lot of parallels there. And I don't know, and I guess that shouldn't be a news flash to anybody, right? Like in any environment where you have any kind of asset that goes up for a really long sustained period of time and goes up in a historical fashion, you're going to have that kind of thinking. I think the difference with this one is this is the bubble that has run into more pins than any bubble in history and just won't go away.
It's breaking the pins.
It is breaking the pins, man. And I don't think necessarily it is breaking the pins, but like you've pointed out, you have this situation that, like we were saying all of last year, the trade war definitely, to me, had that been left to kind of go, on its own, I think it would have ruined and destroyed a lot of stuff.
If you kept things where they were on Liberation Day and at peak China tariffs, the market would be down 50%. At least right now. I think.
My point is, though, is I think that you've gotten to a point with this system and the mechanistic feedbacks that as long as something like that just doesn't disrupt that cycle, I mean, and you keep running the deficits you're running and liquidity keeps pumping, I think this is a game that can kind of go on into perpetuity. I mean, at some point it stops, but where's that at? I mean, I don't know. And you know, that's the other crazy thing. And is there a limit on it? People are like, well, it'd never get to that level. I mean, where is that level? Right? Like,
yeah, nobody knows that.
no, I mean, 60 times earnings on Costco is a joke. I mean, it's, you know what I'm saying? You're at a level on so many of these companies where you're like, listen, if you have 5 minutes and you have Excel on your computer, I'll show you how this is an impossible price, right? It's completely uneconomical. Yet here we are. And it's been uneconomical for a really long time. You know, I mean, that's kind of new, is speaking for Costco, because Costco's always kind of bumped around that 30 times earnings, which has always kind of seemed justified to me because I think they're such a premium brand. But 60, you know what I mean? It's just kind of and especially with a company like that, that's not usually the kind of company. Now, to go to your point though, if I think about Costco and conceptualize it, you made a great point. I remember that day that we found out, where I came into your office and I go, dude, it all makes sense. I never realized that Costco was NASDAQ listed. I never thought about it.
And high up the food chain in the
Yeah.
NASDAQ 100, and that's the ETF everyone uses.
And how many Buffett acolytes do you have out there, right? You know, that buy and hold Costco forever because Buffett, you know what I mean? So you start thinking about the share, like the demand there is for Costco shares. And mechanistically, you can quickly understand, oh, okay, that's why.
It completely dwarfs the amount of people that would sell based on it being expensive.
Yes.
And that goes for the whole market.
Yep.
Now,
So,
you know, theoretically, you know, international managers that have, you know, $30 trillion invested in the US would at some point see a number and go, that's too much, and pull some money. Because
you'd think you're there. I mean, at 60, you'd think that.
Well, I don't mean Costco. I mean the market writ large. But you know, so that maybe the natural, you know, governor on how high things can go would be partly on international capital deciding, you know, that's enough. But although, you know, if a year like this year continues throughout the rest of the year, then it also is just a monkey wrench of, well, your capital was better treated elsewhere. You know what I mean?
Well, the other thing too, you and I were talking about this. At one point, I think we were up did we ever get to 15% up on the market at one point?
I think we did for, you know, a very short amount of time when the market was still getting smashed.
Yeah, we're up somewhere between 7 and 8 now on the year. So still with a nice lead on the overall market here. But boy, that lead's been cut down. And you know, that's one of the other tough things about these deals, because in this market, because of those flow dynamics, even if you own the things that are economically benefiting the most, right, that fundamentally are benefiting the most, right? Because you got, trade war off, right? You might own some value stocks that are going to greatly benefit from the fact that trade war isn't on. You could have a basket of the companies that benefited the most financially from any given environment. And I'll even go further. I'll even say, I'll bet you dollars to cents that that's not the best performing basket of the market. You know what I mean? Just like it's added a whole nother layer to the game, because, and it's always worked like this to a certain extent. This is just so much more now, where, you know, you and I have this talk all the time. When we're sitting there looking at investments, we're sitting there trying to analyze what makes the most financial sense and what company is going to benefit and this, you know, but then we also include in it, but does that mean it's going to perform the best? You know what I'm saying? Like, you've got to look at that other part of it, which,
yeah, you better. I mean,
yeah.
And that's why, you know, all the work goes into trying to figure out what systematic investors are going to do, and understanding options regimes and passive regimes and all that stuff, because you either know that stuff or that stuff kills you. I mean,
yeah, and you get run over in the process. And, you know, before I managed this amount of money, and before I did this as a career, you always have this belief of, I'm going to be disciplined and I'm going to stick by these names no matter what. And there's virtue in that. And there's this idea that that is the only way you can't ever lose. You know what I mean? Like, you stick to your, and I've just found out that's not the case.
It might work as an individual. Like,
Maybe.
if you're right about a company dramatically increasing the earnings over time, you'll do fine.
Yeah, eventually the stock price will catch up, right? But it does not mean, and even if that company significantly outperforms the average company on the S&P as far as earnings growth goes and revenue growth, it doesn't mean it's going to outperform the S&P, right? Like, that's, and that is, I think that that's sort of a new feature of the market, in the sense that I think that you've always had anomalies, but typically, if you wanted to know why stocks were at the top of the index, the answer was revenue and profit. That's not the case anymore.
No.
And that's just nuts to say.
That's true, and I agree, but I think it still has a huge part of it. I mean, if you look
I agree. Yeah.
earnings growth of the top 10 of the last decade is wild.
Yeah, and then you also can't play the game of picking out 5 or 6 insanely behaving securities and paint the S&P writ large that way. It is just bizarre to see some of these overvalued names. Like, I'll even throw Apple onto the list, right? I mean, as widely followed and as well understood as that company is, then to turn around and look at the valuation, you're just like, you know what I mean? Like, nobody out there well, you know what? That's not true. I guess people that are sitting on big Apple gains, but nobody out there thinks Apple's growing at 15% a year. You know what I mean? It's not a secret. But, that being said, nobody wants to be shorted, which I understand. I mean, that makes sense. So what else do you see today that caught your eye?
We had housing starts and permits. Both came in a little below expectations. Permits are actually 2-year low, down about 6% year on year.
And that's not coming from a high place last year.
Not a great place. Starts are picking up for multifamily, like basically apartments in the South are picking back up, but single family housing starts falling. Still not like at a terrible level where you feel like, oh, there it goes, like it's on now, but it's weak. So that's gonna be interesting to watch. We have home sales data next week, and that's about it. Like, next week's a total data like desert, thankfully. The other thing that's big today, when we've been talking about it all week, was the budget legislation, and that literally failed today. It couldn't even get out of the budget committee because the conservatives wouldn't vote for it. Not only that, but they're not even going to work on it the rest of today or over the weekend. So it's basically like a see it Monday kind of thing there. And this is tough because
the conservative, I haven't read the news. What did they come out and say? Did they say they wanted to see more cuts?
Exactly.
Yeah.
So, and
here's the thing though. Do they?
What makes this impossible is if you give the hardcore conservatives, the Freedom Caucus types, what they want, then the moderates won't vote for it. So like you have a balancing loop where you push too far this way and you can't do this, and then vice versa. And then even if you do what you have to do to get it out of the House, the Senate will be like, yeah, no thanks, and they'll just change it, send it back to the House in a form that like goes back to the conservatives are going to want to say no to.
Here's a question that we haven't talked about. Now, I think you and I both know it's a different angle on the discussion that we were just having that I just thought about. What do you think the impact or the reaction would be in rate markets if the conservatives in the budget process won out and they got meaningful spending cuts? One of the things I hadn't thought about, because I'm a big believer that in a vacuum, if you start cutting meaningfully of this government budget, if that budget deficit starts to fall, I think with every little move that budget deficit falls, recession odds are pushing higher.
Yes.
Okay, that would be my thought.
Right.
Now, what if you drastically cut spending, right? And try to do it in the least pernicious way, but like think about a way they could come out and cut spending that was kind of like, people sat there and went, holy smokes, they're serious. What would the reaction in the rates market be, and how much?
Straight down. I mean,
The rates would drop
me,
like a
yeah,
rock.
to me, like
Would that potentially offset economic weakness from the spending cuts? I wouldn't think it would, because as we've
not
learned,
fully, but it would help a lot.
yeah, rates have to feed in where spending is right now.
Right. And because
But if you had 30-year money come down 150 to 200 basis points, I think housing would reignite like crazy.
from a horrific base, though.
Yeah, that's true.
The problem is, like, no matter what you do, you can't get that refi boom, because that refi
Right.
boom was struck at zero essentially,
Right.
on the 10-year. So so you can get people that want a house now, you can help them, or want a car now, you can help them, but you can't there's no more refining the way you've had with every ratchet lower for 40 years. So that's dead. And that was a very, very stimulative thing. Every time that millions of people got to refi, you're talking tons of money saved. And that's over. So, but still, we've been stuck with pretty tough mortgage rates for 3 years, 4 years. And if you let go of that, I mean, it would help the economy a lot. You would be able to get building activity way back up and stuff. So there's no doubt it would help. I just don't think it could actually offset, especially like we talked about yesterday, like a lot, especially if those
because
cuts,
you've already been there too. If
the cuts pressure the states,
yeah,
it's even that much more kind of pernicious.
well, no, and that's the other thing that I haven't heard anybody talking about. It's funny to bring up, and I keep forgetting this too, because you're like, of all the reasons to be bullish now, all the Fed cuts, and you go, okay, real economy talk now. When we do get aggressive cuts to the downside, this will be the least impactful, in real terms, the least impactful Fed cutting cycle of all time.
Yeah, I'm of the
It
view,
has to be.
I'm of the
It
view
has
it
to
just
be.
basically it almost doesn't matter.
It almost doesn't, because you're right. Because when you came out, and for those of you that don't remember, or that maybe weren't old enough to remember at that time, there is absolutely no question that refinancing home loans helped get us out of the recession of 0809. There's no
Big time.
question.
Big time.
Okay. It was like an ATM for the rest of the economy, and that is gone.
Yeah, I mean, a reasonable move lower in rates saves a decent chunk of mortgage payers like $1,000 a month.
Yeah.
That they can reapply and and aim at other areas of consumption. So, and we already see like some pain in the more optional areas of consumption, and we haven't even had tariff price increases hit yet. Now, granted, those aren't going to be massive because we've brought tariffs down, but on that, like Walmart this week came out and said, like, that's great that we have the trade truce and stuff, but like, oh, we still have to raise prices.
Yeah.
And no one does more on earth to not raise prices than Walmart, and to keep cutting them. But that's because we've had this falling inflation, falling interest rate, and not to mention labor price arbitrage with China for the last 30, 40 years. Like, most of those things are at least kind of over. So they said, like, yeah, like next month we'll raise prices. The next month probably some more. If Walmart's going to raise prices, like that starts messing with real incomes, and especially from people at the bottom. So you in that way you might start to get pressure kind of from both ends. But the way it looks like the budget thing is going, to me, is my guess is by the time this whole thing's done, now they may break it up into multiple bills the way the Senate's wanted to do all along. But almost no matter what, the way I see it going is the Freedom Caucus has to eventually just eat it and fold, and we don't get real cuts. So the way they've structured it in that House bill so far is you front load all the sugar and you back load all the veggies.
Yeah.
So anything that's good that you're going to do, like tax cuts, oh yeah, that's right now, that's today. And if it's bad, if it's some Medicaid cuts or taking away some of the IRA tax subsidies or whatever, that all starts right after President Trump leaves.
There you go.
Which means somebody will come in and be like, no, we're not going to actually let that pain come, 3-4 years from now with the legislation.
And this is the problem that we're in.
So it's fake cuts.
Yeah, this is the problem with can kicking. We're kind of at that place now where, and if you look at it, there really aren't any other levers to pull anymore in terms of, other than fiscal.
For now, the Freedom Caucus is saying, like, we're not going to kick the can. We're done kicking the can now.
Well, I'll tell you this right now. if they dig in their heels, they're going to own a recession.
Right. And, the pressure they're going to get from Trump is going to be immense. I mean,
Oh, yeah, they won't. I mean,
so my guess is that we'll at some point be the ones that fold, because
I don't think that I listen to a lot of those people talk. I agree with virtually
Right.
everything they're saying about the deficit. And
they're not wrong.
no, but I listen to them and I go, do you understand the cost of what you're talking about? Do you fully understand the cost? Right? Like, I'm in favor of it. I mean, it doesn't sound fun. I'm in the securities business. Up and to the right's better for us. Right? Like, I'm with you. Long term though, I'm willing to take a nasty recession. We've got to get off this. Right? Like, it's one of those things. You're going to have to do it eventually. The sooner you do it, and if you do it on your own accord, it's going to be way less painful.
Or you go supernova growth inflation to burn the debt burden down. It's, at the end of the day, they're both just giant taxes on the population.
And there's no way you get out of it. You got to pick your poison.
Right.
And right now we're trying not to.
Yeah. And another thing too, like when it comes to you thinking about the budget deficit, is one of the things that they said was like, a lot of people have said like, it's fine that we're going to do these giant tax cuts because we're going to fund it with a bunch of tariff income.
No.
But then we brought the tariffs down. It's like, okay, well, that's gone.
Yep.
So to me, just what I think probably comes is you just have really big deficits, and maybe even bigger than current deficits, right?
Jeez.
And the deficit this year is bigger than last year far. So
that's a fairly consistent trend.
But that, between that and the trade deficit coming down, but not significantly, like those big forces that would hurt U.S. stocks that looked real, 2 months ago, don't really look real anymore. So base case has to be U.S. stocks are probably largely fine, unless the people that run big money in Asia and Europe decide, yeah, we don't care, we're still getting our money out of there.
Well, even then, I think U.S. stocks can be fine. I just think that you're going to see rallies get met with selling, and I think you'd continue to see international markets outperform, because it doesn't stop the ETF flow from 401ks and all that kind of stuff.
And speaking of that, like the data on like ETFs like VOO, the Vanguard's S&P 500, they're outpacing last year by a lot on inflows. Like, I mean, just enormous buying of the more passive index ETFs, just huge flows, hundreds of billions of dollars you're talking about. So
wow.
So from that standpoint,
well, the other thing I will say, I almost forgot to tell you this, but I was at a baseball game the other day, and I heard there was one person that I spoke to that thinks more along the lines of you and I, but I heard multiple people bragging about the fact, oh yeah, I've been buying the last 3 weeks, and I was just sitting there going, this is so inverse of what, like, the way things work in markets typically. And there are so many investors that have just been trained. Stocks are down, just buy it, just buy it. And, as long as you're in this dynamic where, like, as far as the US goes, I mean, let's be truthful right now. For you've got to worry about short bouts of volatility. But as long as we're in the regime that we're in right now, you don't have to worry about big crashes.
No, and I mean,
they're not going to allow it. They're going to print. They're going to up the deficits. They're going to do whatever it takes.
And it's never looked more real than this time, where
they're
like, we don't care about stocks, and like Main Street over Wall Street.
And then they did.
And like, we got all that. Like, we got a lot of preaching of like, there's going to be pain. Like
15% down on the S&P got Trump to do a roundabout.
Just total capitulation, more or less, on tariffs now. But I think we do still have to like think about the risk of, we don't know that they stay down. That would be my bet. And speaking of that is news that dropped today. Is obviously we're negotiating with the kind of top 10-ish trading partners, top 15 or whatever, but the rest of the countries, the Bangladesh's of the world that we were going to put huge tariffs on, the Liberation Day charts that became famous, essentially. Now what they're saying they're going to do is 2 or 3 weeks from now, we're just going to send a letter to all these countries and just be like, here's your rate. Nobody knows what those rates are. I guess they're not the same as Liberation Day rates. I guess that's over. Like, that was just like a bad dream. And we have no idea what those rates will be. And they're saying like that those countries can appeal, but no one knows what that means. And so we have to wait and see what those rates are, because that could be another shock where those letters go out and let's say they're barely below the tariff rates of Liberation Day. That would be like a new like market where the market had to be like, what? Like, I thought we were done with this. Like, if they all come out at like roughly 10%, the market can be like, all right, we can move on. But if they're all 25% on some of these countries, or 30 or whatever, then I think the market has to deal with that all over again. So that's gonna be interesting to see what those are. And to me, when I think about Korea, Japan, Switzerland, some of these countries that we're negotiating with, if I'm Japan, I'm not finishing a deal until I see what those numbers are.
Yeah.
Because if you're going to give all these other people like 10, 15 flat, then like, I don't even want to talk to you.
Yeah.
I'm not giving you anything. Just put your 15 on me and like, let's move on.
Yeah.
So I think it'll probably slow some of those intermediate discussions down. So the next real big thing for the market, other than this bill, which is going to take a while, is going to be, I think, what are those numbers on those letters that theoretically get sent out 2-3 weeks, and what does that look like? And if someone's like, oh, I'd like to appeal, what happens with that?
Yeah.
We got a lot of 90 deals in 90 days talk, and I remember like looking at that, like, what are they talking about? Like, how is the administration going to do that many trade deals? And finally, like, they were like, well, we can't, so we're just going to send you a letter.
Yeah.
So that's going to be interesting.
Wild times for sure, man. You got anything else? That does it for me.
I don't think so. Yeah.
All righty, guys. Well, have a wonderful weekend as always. And remember to, we are on social media, YouTube. Just get on YouTube and search Know Your Risk Podcast. On Instagram now, TikTok. Shouldn't be tough to find. So anyway, guys, have a wonderful weekend. We'll see you on Monday. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.